Welcome to the Financial Advocacy Podcast. I'm your host, David Kinder, the tax-exempt wealth guy, registered financial consultant, and chartered life underwriter, and my co-hosts, Michael Moffat and Kurt Gibbs. This is a disclosure where we say you can't hold us accountable for any actions you take on your own, just like all financial entertainment shows. We are not providing legal, tax, or securities investment advice of any kind. We do provide general investment information for educational purposes only, and we will discuss alternative financial strategies that do not contain or include securities. You can view all of our disclosures and disclaimers at our website at www.financialadvocacypodcast.com. Look both ways for across the street. Let's get started.
I still chuckle with myself when I hear that intro. It's like all the fine print that you hear on a radio ad or something, it just goes off. That was kind of the style I was going for, too, just to ramble it all off. Oh, boy.
Hey,
well, welcome back.
It worked, and that's what you got. So
that's what I was going for. And, I get a chuckle out of it now. So, everybody, welcome back to the Financial Advocacy Podcast. We're going to talk today a little bit about year-end planning strategies, tips, things to keep in mind. And of course, this is not an exhaustive list. There's probably other things. So this is a time of year to just make sure that you're taking advantage of things before the start of the next year. Taking advantage of the tax code, taking advantage of workplace benefits, taking advantage of, whatever else is out there. It's just making sure that you're setting yourself up for the next year and that you've taken advantage of the current year's situation. Mike, do you have any thoughts of what we should cover? I've got a couple of PDFs of some things. I want to figure out if you had anything top of mind.
Yeah, no, of course, Medicare is still going on, AEP. So, of course, you want to get that in order if you haven't done that yet. The deadline is, what's today? The 5th? Or what is it?
Today's the 3rd.
The 3rd, yeah. So we got 4 more days here to go until December 7th. So if you haven't gotten that taken care of, that would be, especially if you're 65 or older or eligible for Medicare for other reasons, that would be top of the list for the year-end stuff. But other than that, yeah, I mean, if you have any write-offs or expenses you can use, you might want to take advantage of some of those. But yeah, I think that we'll get into more maybe specifics on some of those things here coming up. But yeah, my main focus this whole last month and a half or so has been Medicare. So that's top of the mind for me.
Well, yeah, and I'm glad you do it instead of me. So at least you've got that top of mind. You know the stuff there. What the other thing that did come up in one of the other PDFs, since it's health insurance related, would be health savings accounts.
Yeah, your HSA benefits.
HSA benefits. So the thing about the HSA is that if you happen to not know, is that it's one of the very few triple tax benefit plans out there. Almost everything has 2 out of 3 tax benefits, whether you get a deduction up front or you get tax-free later. Usually it's one or the other. With the health savings account, you get all 3. You get a tax-deductible contribution, tax-deferred growth in that account, and tax-free withdrawals for qualified medical expenses.
Right. Yeah, that's an important point, right? So you only get the triple tax benefit if it's being used for qualified medical expenses. So, and even on Medicare, I mean, you can use that to pay your co-pays, your premiums, things like that, if you have a leftover HSA from an employer or something like that. So those would be qualified expenses. So if you are retired and you are getting close to retirement and you're wondering what you're going to do with this HSA, those are some of the things, you can use it for, is to pay for out-of-pocket expenses, premiums, things like that.
And I believe, I am not an expert, but somehow this popped in my mind. I believe you can use an HSA to pay for long-term care premiums. I'm not sure. It sounds logical to me. I'm pretty sure that's the case.
I'm not 100% certain myself, but it is a premium, so maybe we'll have to look into that one.
Maybe. So don't hold us to it. We're saying that it's something to look into. Because one thing is, see, long-term care, for tax-qualified long-term care policies, they also, based on your age, have certain tax-deductible opportunities with that as well. Of course, we're talking about true long-term care, not necessarily asset-based long-term care, not necessarily, although there are some asset-based long-term care policies that do qualify for that. And we're not talking about chronic illness riders on life insurance. Those never have that tax benefit.
So Google says that you can.
Google said, what does ChatGPT say?
I don't know.
I think I trust ChatGPT more than Google, but I'm glad to hear that my instinct is right. And of course, I'd look it up myself right now, but I'm the one talking. So no, it's good.
That's what you have me for.
There we go. So it's trust but verify around here, right?
Right.
We can talk about anything, but remember, you can't hold us accountable.
And with all these things, there's always caveats to everything with certain things. So just
you have to be a certain minimum age and stuff like that.
I would ask your HR representative or maybe an accountant or something like that before you take our word for it. So
we should have Brian Summerfield on again and just get the accountant's perspective of other things for year-end tax planning rather than just the things we're going to talk about. They'll probably ratify the same things, but that would be a good idea.
Brian, if you're watching, we need to talk.
Yeah, well, we'll figure it out, won't we? So Penn Mutual is a particular company that we both happen to represent. Good company. And they put out an email to agents and advisors last week about year-end tax strategy. So let's go through it. And of course, we're going to identify anything that's an obvious bias towards them because we do that. So I'm sharing my. Yeah, there's always a bias towards everything. So here's the thing that they're saying. First, consider contributing more to retirement plan accounts. So that's always nice to know, always nice to see. Here's the only thing is that if you're talking about 401k, 403b, those are usually contributed out of salary, not necessarily a lump sum contribution going into your plan. Now, every financial institution should be saying, we'll take your money. We want your money here. So if you're able to make an additional catch-up contribution, if you're 50 and over, you could do like an extra, I think it's $6,500 on top of the regular amount. And we're assuming that it's a safe harbor plan or it meets all the testing. I'm not going down that rabbit hole. There's a whole bunch of stuff there to make sure that you can actually put in the maximum amount the IRS says you can. But you can't just say, as an employee of a company, say, okay, let me go and put in 20 grand. And expect to be able to do it. It has to be done regularly out of your paycheck almost all the time. So if you want to make a catch-up contribution or make a lump sum contact your HR department, contact the 401k plan custodian and find out. I don't think you can, but you can always call and find out. Better to ask than not. One thing about IRAs, though, is that you could make an IRA contribution for the current tax year up until you file your taxes. So you have until April 15th of next year. And actually, even if you file for an extension, you have it through the extension date, which is September, October 15th, whatever it is. You can still make your contribution through that period. So double check on that. But you can make a traditional IRA contribution much later. You don't have to do it in the calendar year. You just have to allocate it for that year, and it has to be counted towards your tax return when you file. There's other plans that work similarly like that. So, for example, and I don't have them on, but Kelly Smith, he does ESOPs, and if we're talking about setting up an ESOP plan, you can backdate it. At least through one calendar year. They might have shorted up where you can't do it anything further past that, but you might have to either amend or extend your taxes to make sure you get everything nice up in a bundle with a bow on top, so that you're doing it right. So you don't necessarily have to get it done now. Some plans you do have to get it done now. The contribution has to be done by the end of the year. Other plans, you just have to make sure that it's accounted for in your tax return. Find out with your financial professional, find out with the tax code, find out with your accountant, just to make sure everything's all set there. So kind of enough on that one. Now here's another one, and this is a consistent theme I'm seeing with all these year-end tax plans. Consider funding a Roth IRA or complete a Roth IRA conversion. I have an opinion about Roth. We did a whole podcast about Roth. So let me share that opinion here real quick. Where did I put it? I had it. There it is. This is my definition of a Roth IRA. A Roth IRA is a stripped down, government regulated, benefit reduced imitation of cash value life insurance to help banks and brokerages offer accounts with somewhat similar tax benefits. Now, obviously, my bias is showing through there, right? The question is what are the benefits you're missing out on, and does it make sense for you? That's always the bigger consideration there. But when we look at it on an equal basis, life insurance outperforms dollar for dollar easily. And I'm not talking about as an investment. I'm talking about for the benefits that are afforded in the tax code. Roth IRA. Now, here's the advantage of a Roth, though. The Roth is that if you're making a one-time contribution and that's all you're planning on doing, and you're not going to make, or you don't want to make plans to make annual contributions year over year for a number of years, go for a Roth. That would be the simpler thing. If you're planning to make multiple year contributions, or you're going to transfer money from one asset into another, and as we often say, we take something that is forever taxed, we get the taxes out, we put it to something that is never taxed, then life insurance could be wonderful for that if you could get the offer. We'll talk about that one more later. So anyway.
I know we're not big fans of 401k for many reasons on this particular show, but just as a point of reference, if you're going to contribute to one, Roth versus traditional 401k, how would you feel about that for the average consumer? Which would you rather contribute to and why?
And everything always depends, right? That's
right.
The first thing. There's always all these other things to consider. So the other part I would probably consider is there a match?
Mm-hmm.
If there's a match, I would never go past the amount of the match.
Right.
Because the match is free money. But the goal of the match is not that it's free money. It's that I want that match to grow along with the amount I put in, so that the match pays my taxes or less. So I get more of the match for me. That's the goal.
And if there's a match with a Roth, the match itself is taxed, not your contribution.
That's correct. Yeah, with the Roth. So far, I have not seen anything for the Roth 401k where the match is tax free.
Right.
Because the thing is that the company needs to have a tax deduction. Otherwise, if they're not going to get a tax deduction, why are they doing it?
Right.
So otherwise, if it's going to be considered income for you, well, then that becomes a realized taxable income for you, which then you have to pay taxes on, to the whole mess. So until they make some exception in the tax code, which hasn't happened yet that I know of, something might have happened I don't know about.
I'm not aware of it myself.
I think someone would have mentioned it in our Facebook groups. Someone would have said, "Hey, look at this. This is new. This is revolutionary. We need to get." Well,
yeah, I mean, right? Because to your point, the employer is looking for the deduction now. So what they're going to do is take that deduction on the Roth side, and that's why you're going to have to pay taxes, at least on their match, when you go to distribute the funds. Now, if there's no match and you still want to contribute to a Roth or a traditional 401k, pre-tax, if it were me, I would go Roth every time, because you're taking you're paying taxes now on a smaller amount, when hopefully in retirement you're drawing out a larger amount at an unknown tax rate, probably higher, because in reality we're really in kind of the lowest tax environment we've ever been in. So it would make more sense, in my opinion, to contribute to a Roth versus a traditional 401k, where you're going to have to, you get a small tax deduction now and pay taxes on a much larger amount, hopefully a much larger amount in the future.
And yeah, exactly. You're what we're doing is we're trading. I'd rather have the known tax today rather than an unknown tax in the future on this larger amount of money, and we don't necessarily know what the rules are going to be or the tax rates are going to be. So I'd rather have my known tax paid today rather than an unknown tax tomorrow.
And on an unknown amount as well.
Yeah, exactly. And the neat thing is that at least with the election being over, we have a little bit of certainty of what we can generally anticipate regarding the tax code. Now, what that means for the national debt is a whole nother topic. But at least, President-elect Trump has every reason to continue the tax code as it is, at least, let alone all the election promises. We'll figure that out as we go. But at least we know we could probably anticipate for at least the next 4 years, if not the next 8, if we could get the tax code ratified through that long, of what the tax code is going to look like. But yeah, I don't want people, and this is our friend Van Miller, he would say the dangers of tax deferral are hidden in the benefits of tax deduction. And so it's so important that we understand that we count the costs of the consequences of what we're considering. So it's all of that being put together. If someone's just starting out, I'd rather see you have some money somewhere. But the more that we accumulate, the more successful we are, the more it becomes a critical consideration. So, like everything, if you're 25 years old, get started with something. Don't do nothing. Make sure you're getting out of debt, and make sure you're doing everything you can. Take advantage of that 401k, sure. But once you're starting to really see some success, your financial strategies should evolve with you. So that's something to very much keep in mind. So great points. I think we hammered that one. So third one here, evaluate different distribution options for your IRAs and or qualified plans. So we're talking about required minimum distributions. And this really depends on, do you need the money or not? And if you need the money, make sure you get it done. Otherwise, you have a penalty for not taking out what you should have taken out. The penalty is lowered, though. It used to be 50% of what you were supposed to take out. Now it's 25% of what you're supposed to take out. So there have been some changes in that with the Secure Act 2.0. But if you don't need the money, and if you're just taking out the money just to avoid the tax, which, better to avoid the tax than incur it.
Yeah, for sure.
Could that be deployed in your financial strategy in another way? Can we make that inheritable? So perhaps a life insurance policy makes sense. Perhaps doing an ILET with a trust, for those funds. Everything depends. I'm just saying that you can take little money and use it to buy bigger dollars to leave a greater inheritance than what you originally planned on, as long as you don't feel that you need the funds.
Yeah, and this catches a lot of people off guard going back to Medicare, where they have to take a large RMD all of a sudden, or they have a large windfall of money, and this can affect your Part B as in boy and your Part D as in drug, IRMA, your income related monthly adjustment amount. So sometimes people get these, they take these large RMDs, or they have these taxable events, they sell a house, or what have you, and it's how they look at Part B is kind of the previous 2 years of tax returns. So
right.
When you get that, a lot of people are caught off guard, and they end up having to pay a much higher Part B and Part D premium than they expected to. So just keep that in mind too, that when you're taking this money out, that depending on how much you take out, your Part B premium might go up from the standard premium, and same with your Part D premium. You could be assessed an additional charge on top of whatever that Part D is if you have a standalone Part D.
So in other words, you're damned if you do and you're damned if you don't.
Right. I just want to bring it up because a lot of people get caught off guard, especially if since it's a 2-year look back, right? And then they did this, and they might not get hit with it right up front, but then 2 years down the road, all of a sudden they have this large premium that they owe, and that's why. So just be something to be aware of, is that it's not going to affect you necessarily this exact year, but if you're doing it 2 years from now, you could see a substantial increase in your Part B and your Part D premium, income related monthly adjustment amount premiums.
And there are ways to appeal that. I think I've actually got the appeal form on my website, just in case it was to ever come up. You can always ask, you can always petition.
Right. It never hurts to ask, right? So It's like there's no stupid question. The only stupid question is the one you don't ask. So, I always told my students that when I was teaching insurance class. So, your question isn't stupid, but it is stupid if you don't ask it. So,
Yeah, and better to well, what's the phrase? Easier to ask for forgiveness than beg for permission. Um,
yeah, right.
you know, I'm sure that applies somehow. I'm just thinking. I probably have it mixed up in my head here, but you've got to accept the consequences as it is now. But that doesn't mean you can't appeal the decision and your situation and see if it can be relieved. So,
Yeah, I mean, if your financial situation, and that's a good point because if your financial situation has drastically changed, and that, those IRMAs that you got from 2 years ago, you're not going to be able to afford that. It never hurts to appeal. That doesn't mean you'll win the appeal, but it never hurts to ask.
yeah, just fill out the form, submit whatever documentation is needed, and you go from there. But yeah, hopefully this financial situation isn't because of market losses that tank your portfolio and such. Which the good news of that, we don't want this as good news, but the good news is that your RMD would go down with the fact that your portfolio went down as of the end of the year. So if your portfolio is down 50% on December 31st, your required RMD is also lowered because of that, because based on the December 31st balance of the prior year.
Right.
So, yeah, just
Cool.
important to kind of keep it in mind, balance it all out. One thing that, see, it took me a little bit to try to figure out how we we're going to cover this topic. And the good news is that when you have life insurance and fixed index annuities, we don't have to deal with half that stuff because the stuff doesn't go down. When it doesn't go down, you don't have to worry about it as much. You have more predictability, more certainty, promises, protection, and guarantees. All those things are there because you don't have to worry about half that stuff. And if we could take out half the worry, that makes our compensation very much worthwhile. That makes planning so much more peace of mind. You don't have to worry about half that stuff.
And as long as it's not a mech, if you're using your cash value life insurance as collateral, there's no taxes at all.
No taxable event.
There's no income.
Which is something when I talk to people who definitely know taxes, they do tax filing, the tax preparations and such. And I have to explain to them, because I've got the moniker, the tax exempt wealth guy. Well, what do you mean tax exempt? What's the difference between that tax exempt and tax free? And the biggest difference is that tax free still generates a 1099 form. Tax exempt does not. And that's splitting hairs. Like, well, it might split hairs to you, but the ripple effects are huge.
Mm-hmm.
So, there's a big difference. And once that understanding is there, now they see why I love that name as opposed to just saying, tax-free retirement, which is what everybody else seems to talk about. I think they overuse the term, unfortunately for them.
And even the GAO report and other things, whenever you look at, distributions like that, even from life insurance, they all say it's tax-free, but really it's tax exempt as long as it's not a MEC. So that's it kind of is splitting hairs, but in a way it's not, because it literally cannot be taxed because you're withdrawing in the form of a loan, and loans aren't taxable. So
yeah, it's just a transfer of capital from one party to another. That's all it is. Okay, so we got some more here. Another thought here is to increase your charitable contributions. Now, I'm putting together a course for business owner planning for financial professionals, and I have yet to get into the charitable planning part of the course. But charitable planning is a big part of the Americans are generally charitably minded. We donate to churches. We donate to other associations and organizations, like the American Cancer Society and things like that. But we're not talking about little things here. We're talking about some big things where it's far more strategy in mind. And so you've got your CRATs and CRUTs and all these things, which are all these different charitable contributions and such. But the main thing is that if you want to make a charitable contribution, you got to do it by the year end. That has to be done by year end. That cannot be, you cannot wait for the next year to donate and do it back. It doesn't work like that for this stuff. So But there's a lot of charitable opportunities. I'm really looking forward to learning far more about them and incorporating them into people's plans, because there's some amazing tax opportunities there for people who are charitably inclined. And you can structure retirement income based on that. So there's some amazing things there. Once I uncover them, I'm looking forward to exploring that more. Now, the last one here, this one is interesting. Now, remember, this PDF came from an insurance company, right? And it says fund a permanent life insurance policy or tax deferred annuity. Now, hold on. This thing, there's no real timing on that. There's not a special thing of the year, other than underwriting tends to be just a hair bit more lenient during the last couple months of the year than any other time of the year. So for that reason alone, that makes it timely that it's there on this page, but they didn't say that. That's the only thing.
I mean, life insurance companies are just like any other business in a certain sense. They're not going to take somebody that's a table, J, and give them, a preferred rate. But, if you're hovering between standard or preferred, maybe they'll bump you up to preferred to earn your business or something like that, whereas they may not do that normally during the year, because they're just like any other business. Like, think about a car dealer, right? It's the end of the month and they want to sell you a car so they can get their car dealer bonus. And, it's the same thing, or any other retailer with Black Friday, right? They all want to get into the black and into their bonuses and everything for the end of the year. So there's going to be a lot more leniency with some of these things. And if you're uninsurable, you're not going to all of a sudden become insurable because the insurance company wants to write a policy.
Right.
But if you can get an app in at the end of the year, maybe there's a little discrepancy between one rate and the other. Maybe they'll, to earn your business, go ahead and give you the better rate. Of course, that's at their discretion, and I wouldn't promise that anybody would do that, but any insurance company would do it. But there is a chance, at least.
Yeah, and this is the time of year to find out. So I saw someone else's post somewhere else, I forgot where, I know it was on Facebook, that was basically calling out other agents, saying that there's no such thing as a Black Friday sale special on life insurance. I'm all for having little gimmicks here and there if it helps get some attention, but it's really not true. There's really no real Black Friday special, but certain underwriting concessions, it's a slight leniency, a slight ease. Hey, you never know. And especially if you're in the borderline of getting coverage and not getting coverage, this is the time to try and apply.
It's another one of those, it doesn't hurt to ask. Yeah,
essentially. I mean, if you're already uninsurable, all you're going to have is another mark on your MIB that says, okay, you tried again. By the way, just to clarify, having your MIB checked and you happen to have a decline does not automatically mean you're going to be declined forever. It does mean that whenever you do apply, if the question is asked on the application, have you ever been declined for life insurance before? The answer has to then be yes, and you have to explain what happened. Or in the circumstance. It does not mean that you're automatically going to be declined forever and ever. It's not like you're blacklisted.
Right.
It is what it is. It just has to be disclosed. So it's kind of like, applying for a job. Have you ever declared bankruptcy? And you have to actually answer yes. Don't you dare hide it. That kind of a thing. When we're getting our insurance license, right? They ask all the background questions. Better to come out and over disclose than not, so that they actually might, if you pass the exam, you can actually get your license. It's the same kind of a thing.
I'll give a good example of this, especially with final expense and some other things, kind of simplified issue type stuff that I'm not a big fan of. But, a lot of times you'll get a, what did you do to the screen? Okay.
I'm learning.
All right. A lot of times, so what I've seen before is maybe somebody was declined with one company for like a height weight issue, whereas another company has a more lenient underwriting standard for that height weight issue. So if you put on the application that you were declined because you were, off on the height weight issue, but it's an okay height weight ratio for the other insurance company, they would likely accept you, even though the first insurance company declined you, because their underwriting criteria would be different. So
sure.
every insurance company, although somewhat similar, they're going to have slightly different underwriting standards. So some insurance companies like to take certain risks more than others. As far as risks go, maybe meaning high blood pressure, cholesterol, whatever it is. Some insurance companies may lean more favorably on certain health conditions than others do. So just because you're declined by one doesn't mean that there's not another out there that looks at that differently and that they're not going to approve you. So it doesn't hurt necessarily to reapply with another company. But if you're working with a knowledgeable and a good agent, I would expect that the agent, once they find out why you were declined, would shop the other insurance companies for you first to make sure that a company you're about to submit an application to would take you knowing what you were declined for first, and whether that's calling underwriting or whatever before they submit an application. But that would be one sign of a agent that's kind of well versed and is a good agent, that they would know which companies look at certain underwriting conditions more favorably than others. So there is a way around that.
Yeah, and it's not just knowing all the companies, because I can't know all the companies. Right. It's not possible. But every good agent either they know or they have all the underwriting guidelines. Wow, that would be a big job. But you have someone else, right? You've got your own back office team, more or less, right. And they'll have something like an inquiry survey. I don't know what it's called, but it's a form that will allow you to ask all the questions, send it to them, and they'll shop it based on the criteria. They'll feed it into an algorithm thing, and based on all the factors, this company comes up as the best chance of getting an offer. Now, you might still pay through the nose for it, but at least you'll get the offer as opposed to nothing.
And those forms, although they're good and they do help with some of the preliminary general underwriting questions, they're not going to be comprehensive necessarily. So once they run your MIB and maybe you have a paramed or something like that, there still may be something that comes up that the agent or maybe even yourself forgot about unintentionally, and so that can happen too. So while it's a good idea to fill out a form and kind of do some, pre-application, kind of fact-finding underwriting type thing to try to fit you in a box, I guess, so to speak, with a company that's going to work for you. There's still things that can come up and sometimes do come up during underwriting that, I just had an example the other day when I submitted a life insurance app. The guy was prescribed a medication a couple months ago that he took once and totally forgot he ever even took it, and it didn't work. And so the insurance company was like, well, what was he on this medication for? And so I had to fill out a little questionnaire and stuff, and then I took care of that. But yeah, so those things do happen. So just because you do a fact finder doesn't mean that that's necessarily the price that you're going to get. There can still be things that come up during underwriting.
Yeah, exactly. Great points. So let me go back into here. I've got this other article. I, of course, legally stole it because I'm not that good. Remember, I'm the Google of insurance. I'm not the writer of the insurance code. I don't write this stuff. I find this stuff. And so I found this article on Forbes. Jonathan Shankman. Now, he's far more investment oriented, but that doesn't mean this doesn't have good information and insights. And he wrote it, this year, so it's current. Wrote it just a few days ago. So let me scroll down here. He mentions RMDs. We've already talked about that. By the way, he mentions a planning tip: utilizing qualified charitable distributions, which allows you to give up to $105,000 from your IRA directly to charity without needing to pay tax on those monies, and they count towards your RMD. So you've got to be charitably inclined. Now, I would like to think that there's a way to you fund a charitable remainder trust, and you have the trust by life insurance, and then you leave the trust the charity even more money for that. So that's another thought. Am I an expert on that? No, but it's a thought of how to really maximize those same dollars. Although the charity wouldn't get the money right away, but they'll get it at some point.
Well, and they would get a larger amount too, eventually.
A larger amount, exactly. I mean, $100,000 a year, and if you're buying it for death benefit purposes, I don't know, $10 million policy, maybe. I don't know.
Depending on what kind of policy it is, if it's a 10-pay, a traditional whole life, a term if you can qualify for it, whatever it is.
Yeah, well, that's what I was thinking. Like, if it's death benefit focused, it would be a minimum premium cash value policy for death benefits. That
Right.
would still buy a heck of a lot of death benefits. So, um, talk about deductions for cash contributions for charitable planning. Um, Apparently, this is a small thing here, but basically, under the Tax Cuts and Jobs Act, the deduction for cash contributions directly to charity increased from 50% of AGI or adjusted gross income to 60%. And if the act sunsets, which will happen at the end of next year, assuming that Trump does not extend it, he will. But if he doesn't extend it, it's going to go back to 50%. So you can, there's a 10% difference of AGI for contributions. Donating appreciated stocks. And in fact, there's a planning strategy with that as well. For example, if you have appreciated stocks that you purchased through your qualified plan, and we're talking about like company stock, and that stock happened to appreciate greatly, there's something called net unrealized appreciation, NUA, where you could actually, instead of paying ordinary income tax on it, you could roll out the certificates. You pay capital gains on the gain when you sell it, and ordinary income on your basis on it, essentially, and you can really save quite a bit. Now that takes a little bit of planning to figure out if it's even worthwhile. You talk to your plan custodian, but that's another thing there where you can take some tax considerations in your retirement planning depending on what kind of stocks you have. So that just reminded me of that. But if you have an appreciated portfolio and you want to donate, you can donate the stocks directly to charity. And he's talking about donor advised fund, a DAF. Again, I'm not as well versed on that. Remember, this is an investment focused guy, so he obviously knows more on those things. That's more in his thing. Number 3, Roth IRA conversions. We've already talked about that at length. This is good. Reviewing your beneficiary designations. That's a big key. So remember, retirement accounts, insurance policies, they all have beneficiary designations, and the designation of the beneficiary trumps. I don't mean to do that, but it does trump the will. If you have a will or a trust, your beneficiary designation beats all of that. So
yeah,
if you had
I can't. It's funny because we've both been in this business a long time, and I can't tell you how many client reviews that I've done where the X was still the beneficiary on the policy, and they had no idea, and they forgot to change it, or something to that extent. And so it is very important, to review these things and make sure that you have the beneficiary that you want on there currently, because that happens more often than you'd think.
I've got a video on my website, and it's regarding a father who passed away, and his adult daughter was supposed to inherit a $400,000 IRA. Well, the beneficiary designation listed, it was handwritten. So thank goodness today, almost everything is electronic, right? You go into the company portal, you change your beneficiary, you fill in the blanks, everything's fine. But he had it handwritten, basically saying, to be distributed per my last will and testament, which automatically means the whole thing went through probate. And because it went through the probate process, it goes through the probate distribution system, more or less. And so it looks to the immediate spouse. Well, the mother of the daughter had already passed away. Dad remarried. And so his new wife of 6 months got to keep the IRA by law. That's the way the probate system works. It goes to the spouse first, no matter how long they've been married. So if you want to make sure that what you want to have happen does happen, double check your beneficiary designations. She was not able to get any penny out of it because the only thing that she could do is ask, and there's no legal requirement that they have to share those proceeds. You can sue for it all day long. It doesn't matter because it falls under that under the law. The law basically already ruled on that. It already belongs to the new wife of 6 months. Oh boy.
So the friendly tip, if you got remarried since the last time you checked your insurance and IRA beneficiaries and all that stuff, might be a good time to double check on all that.
Yeah, and even if nothing even changed, you could still redo it, and just to reaffirm that exactly what you want to have happen.
Right.
So just to say, you know what, nothing might not have even changed. Here's a new paperwork just to make sure it is current with exactly what I want. And all the company would say is, why'd you send this in? Okay, we've got it on file. No big deal. But this one was interesting too, is that other changing dynamics, changing family dynamics. Did a family member who was a beneficiary in your account pass away this year?
Mm-hmm.
So, that's another consideration. Has
maybe you have a child that you were going to leave some money to, and they've become the black sheep of the family, and you no longer want to leave them.
Yes, spendthrift provisions and such, because there's some that they're so horrible with money, and or they have addictive personalities where they're on drugs or whatever else, and you're like, you know what, I don't want to completely cut you out, but we are not going to give you $500,000 so you can go kill yourself. That's the way it ends up being sometimes. People can kill themselves with too much money. So there's other ways to manage an inheritance for that, but you have to make sure it's spelled out. It has to be in the trust documents and such. And again, that's legal advice. Go talk to go talk to LegalZoom. I don't care who you talk to somebody who can help you make that change. So an attorney that's licensed in your state, especially your state of domicile, as your resident state, and or wherever else you need to get that information from. I just know enough to bring it to your attention so that you know to ask the right people. But if you're executor of your estate, if they already passed away, you might want to name someone else. Anything can happen there. So just double check all the players that you have in your estate documents and such.
Yeah, and he mentioned the ex-spouse, which we already.
Yeah, exactly. This was talking about the stretch provision. Well, that's pretty much ended as of 4 years ago or so. So the stretch IRA, that's gone. So making sure that whoever gets what they need to get. Estate planning considerations. These are astronomical numbers for most people. If for 2025 next year, 13,990,000. Let's just make it 14. Why does that 10,000 really make a difference to the federal government? Just make it round numbers. But anyway, it will rise next year to let's just call it 14. 14 million per person, 28 million for a couple. I'm rounding up, guys. It's not exactly that. Nothing's ever exact, but anyway. But then there's the gift tax annual exclusion amount will increase from 18,000 per donee to 19,000. Now, this is a way of helping to move and transfer your estate while you're alive, and that's the amount that you could do so without incurring any gift taxes. Gift taxes, if you're donating, transfer your estate higher above that, there are gift taxes. So just keep that in mind. That doesn't mean not to do it. It just means you better know what they are so you can have it included in your planning. What else? Split. Okay, we're talking about gifts and ownership. Okay, ownership changes. I don't see anything there. But spousal lifetime access trust. That's another thing I've never really heard of. So that's nice. I'm glad it's mentioned. I'm not going to worry about it right now. Planning in a changing interest rate environment. More than just lending and bond investments. There's some estate planning strategies. I guess there's some other interest rate factors that go into distribution plannings and things like that. So if you have those plans, one day I will know far more about them to talk about them intelligently. I am not that person right now, but it's there. If you have a question about it, if I don't know, I know who to call. I'm not the only person that you would want to reach out to. Let's put it that way. 529 plans. It's funny to put that after the estate planning. I would have put this up higher up in the entire document.
Yeah, that is a little odd. I agree.
Yeah, that's out of order for me. But with 529 plans, if you contribute, if you're in one of the 30 or more states that offer a state deduction when you make a contribution, usually to the home state 529 plan, then that's something to consider. Like the Roth IRA, the 529 plan has a whole bunch of stuff with it, and I'm not as big of a fan of it. Of course, when I'm looking at education planning, I'm looking at it from the perspective of let's maximize your financial aid opportunities, as opposed to let's find a way to save money for you to write the checks to these institutions. So that's my perspective, but I'm not saying not to do it. I'm just saying keep your eyes open as to why you're doing what are you doing. But back when I was selling 529 plans, the main one I used to sell back then was the Virginia plan, because that was for American funds. And California does not offer a state tax deduction contribution, even for the California fund. So it did not matter which state you chose. So we picked the one based on the investment selection as opposed to state tax deduction consideration. So it's something else to keep in mind depending on which state you're in. We already talked about the HSA. That's why I brought it up first. Planning for the business owner. Net operating losses. This is a fun one because with net operating losses, that's going to be a tax deduction. The question then becomes can you leverage that tax deduction to create taxable event to net out? That's essentially what is saying here. And so while that's primary for a business owner, let's also think about a retiree with the reverse mortgage. And with the reverse mortgage, if we recapitalize that reverse, if we pay into that reverse mortgage, the first thing that gets paid is interest. You can make a capital contribution to your reverse mortgage, paying down the balance. You're paying the interest. The interest is tax deductible as ordinary mortgage interest deduction. Can you then convert some of your taxable retirement into tax-free? So it's coordinating your different aspects of your taxes to make sure you're maximizing things so you don't let a possible tax deduction be wasted because we didn't offset it with the possible taxable gain to try to net out. Takes a little bit more calculations to see what your one situation really is. And like everything, we always we should rename our podcast the It Depends podcast. I just don't want to attract a different kind of clientele who might really need depends. But I'm just, but like everything
it's true because a lot of these, almost everything depends, right? It depends on a lot of different things. So it is true. I like that though. The It Depends podcast series or something.
We might do something. Maybe we'll have a spinoff. I don't know, but this is the different. So when we think about like when Trump was debating Hillary Clinton years ago, we're talking about 8 years ago, and Hillary Clinton accused Trump of not paying his taxes. No, he paid his taxes. He filed, and that a certain year he had net operating loss of like $900 million. Now, what did he do to help offset that? I don't know. I didn't study his tax returns, even though they were leaked. I didn't know. I didn't care. The thing is that using that, you got to leverage that through other things to make sure that you're getting yourself into the best financial position, optimized as best as possible using the tax return. And by the way, it does mention that IRS publication 536, which I'm almost 99.9% sure is on my website for important strategy links. It will talk more about what a net operating loss is. And, it won't tell you what you can do with it. It'll just tell you what qualifies as a net operating loss. So what else? Income tax planning ideas. Nothing that really stood out to me on that one other than this same old stuff that we've talked about before.
Yeah, this is a pretty good article. If you want to check it out, go ahead. Like you were saying, Kinder, I think certainly some of these things I would have put much higher on the list than some of these other things, these much lesser known and applicable taxes, tax advantage things that he put in there. But he or she, I don't know who wrote it. But anyway, I think that, definitely the order might be a little bit out of order for some of these things, but it's a great article. And, if you want to look it up and maybe ask your accountant about some of these things, you might have some more tax deductions that you didn't even know about.
Your accountant, your financial advisor, insurance agent, HR, your qualified plan custodians. There's different people to talk to, and we're doing this on December 3rd. So it's not like you don't have time by the end of the year to figure this out, figure out what you
don't blame us.
Do. Yeah, so that's why I wanted to touch on this. And at some point, when I'm really organized, I should have my own year-end planning checklist. Until then, I'll steal from everybody else. We'll just talk about it. And maybe by next year, we'll have our own for the following. Well, next year we'll have it for 2025. sorry, what came to my mind was Project 2025, which is a whole nother topic. But anyway.
Yeah, and to touch on that point, we were kind of talking about that this week, is we do want to maybe get some stuff together that we can offer to you guys, whether it's a free resource or a paid resource, depending on what it is that our listeners can subscribe to and participate in. Maybe some more advanced things where we do some one-on-one videos or what have you, and training with people. But yeah, so that is something that we're looking into. Hopefully we can get that out for next year. I think that's the goal. And I think we forgot to mention at the top of the thing, but we are everywhere now, right? We're on Spotify, SoundCloud, Shazam, YouTube, wherever you listen.
Is that a real one?
I don't know. It might have been at one point. I don't know. But
so okay, yeah, look, we cracked the code. Yeah, we cracked the code. We're on Spotify, iTunes, or Apple Podcasts. We're on Amazon Podcasts and Audible. We're on iHeartRadio Podcasts, and there's a whole bunch of other ones. So wherever you get your podcast, we're probably there. If not, let me know, and I'll think about trying to get it set up over there, wherever that might be. But yeah, we are everywhere now.
If you subscribe on YouTube, think about subscribing over there where you actually listen to things, and then maybe we can hopefully build a little bit of a following on those things too, to get people to watch. And
exactly, there's nothing wrong with double dipping. I mean,
listen.
You get to hear us twice. I mean, I think we're good. But anyway, I don't know. Sometimes I can't stand me more than once a day. But anyway,
yeah, that's fair.
All right, everybody. Well, thank you so much for watching and listening. Make it a wonderful day. Catch us on the podcast. Share, hit like, comment, share, subscribe. Yeah, those are the things. Like, comment, share, subscribe. Smash that like button, and we'll catch you all at the next one. What's that, Mike?
I said we got to remember to do that earlier in the show, right? Instead of waiting until 3 seconds before we end the program.
Probably, but I think at this point, that's when we feel like we earn it. Up front, it feels like I'm asking too soon. So right here, we've given all the value. Now I ask you for to do stuff. I don't know.
There you go.
That's my thing. All right, guys. Next time. All right. Bye-bye.
You have been listening to an episode of the Financial Advocacy Podcast. As a reminder, you can't hold us accountable for any actions you take on your own. Just like all financial entertainment shows, we are not providing legal, tax, or securities investment advice of any kind. We do provide general investment information for educational purposes only, and we will discuss alternative financial strategies that do not contain or include securities. You can view all of our disclosures and disclaimers at our website at www.financialadvocacypodcast.com. Look both ways for across the street. Thank you for listening, and make it a great day.